could also be about the secondary market. So we have that vector also covered. And then we look at banking and insurance as other avenues where corporations can raise finance. So, unlike the earlier days where we were heavily banking dependent, slowly we have other modes by which corporations can raise finance. And with that comes the need to regulate these markets so that there is efficiency in the process of raising finance. So that's what we'll cover. And over to you, Isha, to introduce the speakers.
Thank you, sir. Good morning, everyone. Thank you for attending. Thank you for joining us this morning. Today, we are here for the inaugural session on financial market regulations. We have our esteemed guest, Mr. Rajeshwar Rao, who is the Deputy Governor of RBI currently. He has been the Deputy Governor since October 2020. He oversees matters related to regulations, risk monitoring, internal audit, enforcement, legal affairs, and corporate communications. In his nearly 4 decades of career, central banking, he has handled functions relating to financial market operations, internal debt management, foreign exchange management, banking regulations, and international department. He represents the Reserve Bank in the Financial Stability Board and the network of central bank and supervisors for greening the financial systems. He has also been the member of Markets Committee in the BIS. Shri Rajeshwar Rao is a Master of Business Administration from University of Cochin, and he is also a certified associate of Indian Institute of Bankers. We all welcome you, sir. Along with him, we have our three professors as part of the program coordinators panel. Dr. Arvind Sampath, who is the associate professor and member of Urupika, Center for Macroeconomics, Banking and Finance at IIM Kozhikode. He has been a faculty member at IIM since 2016, teaching an array of subjects including corporate finance, financial markets and instruments, investment analysis and portfolio management, investment philosophies, and fixed income securities, among others. We also have Mr. Abhilash Nair, who is a professor in the Department of Finance, Accounting and Control. His expertise lies in the corporate finance project valuation and valuing real options. In 2011, he was conferred the Best Professor of Financial Management Award by CMO Council TM Asia Colloquium on participant-centered learning at Harvard Business School. Along with him, we have Dr. Mridul Sagar, who is a professor of practice and head of Urupika, Center for Macroeconomics, Banking and Finance at IIM Kozhikode. Dr. Sagar has 3 decades of experience in various central banking functions. He was earlier the executive director of RBI, overseeing the central bank's monetary policy and economics research functions. He was also one of the 6 members of the RBI's Monetary Policy Committee, in charge of taking collegiate decisions on policy interest rates and monetary policy stance, as also of its Financial Markets Committee that takes decisions on its financial market operations. Thank you all. Thank you, professors, for joining, and we can go ahead by lighting the lamp. Yes.
maybe we request that we go and give this talk on a really interesting topic. It's an old topic, but maybe we have a new one. Old one. New one and old topic.
Yes.
Huh?
Here it is fine.
Stick here? Oh. Okay, I think it's okay. Yeah. Good morning, everybody. I hope I'm audible right now. Thank you. Dr. Mridul Sagar, participants in the management development program in the financial market, professors, ladies and gentlemen, a very good morning once again. At the outset, let me thank IIM Kozhikode for inviting me here. It's a pleasure addressing such a diverse gathering of important stakeholders across the financial landscape. The contents of the program actually span issues around the regulatory framework for a diverse set of entities operating in the financial markets, including the banks, securities, firms, and insurance entities. Now, all of you will be aware that financial markets span a wide array of products ranging from the money markets, the GSECs, the Forex, equities, and commodities and derivatives. These products are traded bilaterally, over the counter, maybe now increasingly on electronic traded platforms or at the exchanges. The entities are diverse. They are active in many of these markets. The same entity operates across many markets. They are regulated by different regulators depending on the nature of the entities, and also part of it is regulated depending on the nature of activities they perform. The markets are interconnected, and there is a spillover from one market to the other. We call it monetary transmission. But at the same time, the spillover of risks can also happen, because if one market freezes, the cascading impact can impact the other markets. So this becomes a concern from the point of view of financial stability. So in my talk today, I thought I would cover a few perspectives on the need for market and entity regulations and their interplay, and the tools employed by the regulators and the challenges faced in framing these regulations for a rapidly evolving and interlinked financial ecosystem. To set the stage, it would be appropriate to start at the very beginning. The evolution of financial sector regulations started in a way with the establishment of the Reserve Bank of India in 1934. RBI commenced with the RBI Act in 1934. Of course, RBI commenced its operations on April 1st, 1935. The bank's remit was expanded in 1949 to cover regulation of the banking entities, commercial banks. This was followed up subsequently by expanding the remit to cover the non-banking financial companies in 1964 and the urban cooperative banks in 1966. But I think in a way, if you look at an inflection point for financial sector regulations, I would say that it starts in 1991, when actually the key economic reforms were launched by the government, which have helped to transform and grow our economy. The reforms in the financial sector started with the implementation of the recommendations of the Narasimhan Committee on Banking Financial Sector Reforms. Some of the important measures taken as a sequel to the recommendations of the committee included introduction of the private banks, prudential norms for the banks, capital adequacy standards in alignment with the global standards, and conferring of statutory provisions to the RBI to have greater oversight over the non-bank financial companies in 1997. This, together with the subsequent changes in the monetary policy framework, the liberalization of the exchange control regime with the enactment of the Foreign Exchange Management Act, and the powers given to RBI to regulate and develop the payment and settlement systems, the changes in the money, foreign exchange, and government securities markets have actually influenced the approach of RBI towards regulating the financial sector entities in a way. But along with this, there were other developments which are also very important. In 1992, the Securities and Exchange Board of India was set up as a regulator for the capital markets. The subsequent decades, we also saw establishment of new financial sector regulators in the form of the Insurance Regulatory Development Authority of India, and also the Pension Funds and Regulatory Development Authority to look at pension funds. More recently, in 2020, we also had the International Financial Services Center Authority created to regulate and promote financial products and services and institutions within the Indian International Financial Service Centers. Collectively, these regulators play a very critical role in transforming India's financial system into a more resilient, market-driven, and consumer-centric ecosystem, while facilitating sustainable growth for the country. Now, let us try to look at how we should approach regulation making. The one argument would be approach a laissez-faire approach towards regulation of financial markets. Minimal regulations is the best, but that operates on the assumption that self-regulation will be effective. However, this is a view which is contested by some economists and policymakers who argue that regulation is not just necessary, but it's also essential. They contend that the idea of an inherently self-correcting market is more of an ideological fad rather than a factual occurrence, and that effective oversight is crucial to ensure stability, transparency, and protection of the financial sector against systemic risks. I think Joseph Stiglitz, the Nobel laureate, in his work Free Fall, has made the comment that crisis has made it clear that self-regulation, which the financial industry promoted, and which I view as an oxymoron, doesn't work. Time and again, it has proven that financial regulation is essential not only to prevent market failures, but also to protect consumers and safeguard the stability and resilience of the broader economy, particularly in terms of financial crisis. You look at the episodes of the global financial crisis in 2008. Then recently you had the LDI episode in Bank of England. Then you had the failure of SVB and the First Republic Bank in US, where you found institutions have failed, but the regulators have stepped in quite aggressively to ensure that the impact doesn't spill over to the entire financial system. So regulations in many of these areas is necessary. And but the counter argument normally given is that regulations stifle growth. So I think I would like to address this issue that regulation inherently imposes restrictive barriers is a bit inaccurate. A well-designed financial oversight framework underpinned with thoughtfully crafted regulations will not only ensure a level playing field, but also foster sustainable growth and development. Before we look into the specific approaches for regulation making, I think let us also reflect a bit on what are the broader frameworks of the financial systems regulation, the architecture which are in vogue at various points in time or in different countries. To begin with, you can say there are broadly three main models. The first model of oversight for financial sector is the sectoral or the traditional model. Here, each of the financial sector authority is responsible for both prudential and conduct aspects of this financial sector. Think of RBI regulating banks, or SEBI regulating securities market, IRDA regulating insurance, PFRDA regulating pension funds. So this is an approach which is followed not only in India, but also in Brazil, Hong Kong, and Mexico. And it remains a very commonly used model across the world. However, challenges are there in this model in that it has problems in dealing with financial conglomerates when activities blur the boundaries between different types of financial institutions. This kind of conflict can be addressed by having complementary arrangements like those adopted by the Indian financial sector regulators, which I thought I will cover a bit later. An alternative approach is an integrated model where a single agency oversees all oversight functions, including regulations across the industry. This model was adopted in Singapore in 1984 as a consequence of reforms in their financial oversight architecture. Later, the Scandinavian countries adopted a similar model, which was followed by UK, which established the Financial Services Authority in 1997. Other countries like Russia, Japan, Germany, and South Korea have adopted this kind of a model in their financial architecture, especially for supervision. While this approach offers a cohesive and streamlined framework for looking at the financial services sector, enabling unified decision making and reducing the regulatory arbitrage as well as improving coordination, it can present operational challenges like possibly a single point of regulatory failure, a dilution of sectoral focus, and reduced flexibility in addressing the needs of the different subsectors. The third model which is used is a partially integrated approach, what we call the twin peaks or a twin sector model. The twin peaks model was first adopted in Australia in 1997, followed by Netherlands in 2002, and thereafter introduced in Canada and South Africa. Here you have two separate agencies managing prudential oversight, one looking at prudential oversight, other looking at conduct related issues, but for all the entities involved in the process. I think a good example has been that of the United Kingdom, where the FSA was disbanded and you had the twin peak model when FSA was bifurcated into two institutions, the Financial Conduct Authority, which focuses on market conduct, and the Prudential Regulatory Authority under the Central Bank of England, which is responsible for prudential regulation and supervision of banks, building societies, credit unions, insurers, and investment firms. The Twin Peaks model actually leverages synergies in the prudential or business conduct oversight of various types of institutions, but again faces challenges of a lack of sectoral focus as the integrated model and coordination challenges as in a sectoral model. The two agency model is another example of a partially integrated model where one agency is responsible for regulation and supervision of both banks and insurance companies, and a second agency is responsible for market integrity and securities. This is in place in countries like France, Italy, Malaysia, and Saudi Arabia. The models in US, of course, and has a different characteristics. In USA, the functions are assigned to various agencies at the federal and state level. In fact, I think there are more than 5 or more entities who are involved in the regulation and supervision process there. In the European Union, countries within the Eurozone share a single prudential supervisory authority for significant banks. Each model actually involves a trade-off between synergies and potential conflict of interest and challenges. The decision to adopt a financial oversight model depends on the structure and the evolution of the financial sector, the legal, cultural, and political economy considerations, as well as the past experience in dealing with financial crisis. Whatever be the model, I think what is important to register is the fact that in any financial oversight architecture, the central bank remains the primary or the lead authority. Its leadership in coordination with other regulatory entities reinforces coherence, resilience, and credibility of the overall financial oversight architecture. And of course, it's very noteworthy also because central bank is the lender of the last resort. So whatever be the problem, ultimately the liquidity has to be supplied through the central bank, directly or indirectly. Now, given this kind of models, depending on whichever model you choose, the approaches which the regulators can make to look at regulation making can be different. One is, should we have a principle-based or a rule-based approach, or should it be an outcome-based approach? In a principle-based approach, we essentially use high-level state policy statements, laying down the principles and give it an explanation of the underlying intent. This gives the flexibility and freedom to a regulated entity to innovate by developing new products and services without being constrained by prescriptive rules. However, it is open to subjective interpretation, and that can pose challenges both for the regulated entities and supervisors. In fact, I think when I was attending one training program, I was told like FSA used to have the principle-based approach. But in that principle-based approach, maybe 50 principles, but 8,000 pages of guidance on how to understand or interpret the principle. So it becomes even more prescriptive than a current kind of a rule-based approach. In cases like consumer protection, where you can have clear and actionable directions, a rule-based regulation is that much more effective as compared to a prescriptive or a prudential-based approach. It has better clarity, compliance is easier, consistency is ensured, and understanding of regulations is simplified for the regulated entity and the consumers. But the problem is it can also lead to a tick box culture where when you want to do compliance, you just tick the boxes and say that we have complied in letter. It may not have necessarily complied in spirit. So this can actually create challenges when you require to address dynamic issues where a nuanced judgment is required. In India, if you want to look at examples, I think the best example would be, let us say, when we talk about management of credit risk, it's a more of a principle-based approach. But if you look at master directions on priority sector lending, which mandates you must give 40% of the adjusted net bank credit for the priority sectors, or this is the target for the weaker section. That is kind of a rule-based approach. But another approach which is gaining prominence of late is the outcome-based regulations, which focuses on the desired outcomes or results rather than prescribing specific processes or tools. This approach sets what is the desired outcome while providing flexibility on how to achieve it. One of the recent example, which I would like to cite from the Reserve Bank context is our directions on digital lending, which emphasizes the desired outcome, that is transparency and fairness to borrowers, rather than getting into specifics like prescribing the lending rates or the method of lending. Striking a balance between these approaches is critical to creating an enabling and effective regulatory environment while encouraging innovation, given the complexities of today's financial landscape. Another way of looking at it is activity versus entity-based regulation. Activity-based regulation prescribes regulatory obligations for a specific activity based on the principle of same activity, same risk, same rules. One good example, recent example, is the guidelines which we have issued for microfinance loan lending by the entities. It is the same set of prescriptions applicable to the banks, to the MFIs, or to the non-banking financial companies. In contrast, actually, entity-based regulations, let us say the capital adequacy standards or the income recognition standards, aim to bolster the resilience of activities with focus on the entity. This approach encompasses governance, prudential and conduct requirements, which are, of course, enforced through better supervisory interventions. And given that an entity's overall resilience is shaped by the composition of its activities, entity-based regulations targeted restrictions is an essential feature of this regulation. Given the distinct regulatory domains and keeping in with the objectives of financial stability, regulators often adopt a hybrid approach that integrates elements of activity-based as well as entity-based regulations. Typically, when you look at it today, banks have certain prescribed standards for investments in the capital markets, how much they can invest in the equity of a company, what is the overall limit. There is a limit on capital market exposure. But at the same time, when they do merchant banking activities in the capital markets, they have to comply with the SEBI-based guidelines. So you have an activity-based regulation prescribed through SEBI, you have an entity-based regulation prescribed by the RBI. So a mix of both is now something which is in vogue and is increasingly being looked at. Another way of looking at it is whether we can also go for a risk-based approach towards regulations. So I think that is something which is increasingly finding favor with us as regulators, because it enables us to frame regulations that are both effective and proportionate to the given the risks which the entity carries. This also helps in ensuring that we optimize the use of scarce regulatory and supervisory resources while fostering innovation and inclusion. One good example of kind of a risk-based approach is your scale-based regulation for the non-banking financial companies and the revised regulatory framework which we have adopted for the urban cooperative banks. As I already mentioned, because we have regulators who have different spheres of activity, we are in a situation where there is one regulator who is responsible for an entity and you have another regulator who is responsible for the activity. As I already mentioned, you talk about merchant banking activity or custodial business, it is regulated as an activity by SEBI, but if it is done by a bank, the bank also has to comply with the requirements of the RBI. You look at, let us say, a listed bank, there are certain governance norms prescribed by the RBI under Banking Regulation Act. Along with that, there is a disclosure requirements prescribed by SEBI, which also the listed bank has to imply. So both activity and entity-based regulation are increasingly becoming prominent and something with the regulated entities have to comply with. And this also puts a challenge to the regulators in the sense that the regulators will have to have better coordination between themselves so that they can address this issue. You cannot have some prescription made by, let us say, RBI, which is in conflict with that of prescribed by SEBI or vice versa. So coordination between the regulators is something which is necessary. Again, I will touch a bit on that a bit later down the speech. So when we look at it, since we have a plethora of options in the way we look at the regulations, a model which we can adopt, the kind of approaches which we can adopt for regulations, regulation making is becoming a more challenging field or a more complex process. The process actually starts with identification of risks or gaps in the existing regulations, evaluating the options to address them, and coming out with an appropriate and effective regulation addressing both the risk to the entity and uh, to the financial system. Here, both things, risk to the entity in terms of ensuring its prudential conduct, ensuring its resilience, and ensuring financial stability, and also the conduct part, ensuring a fair deal and fair treatment to the customers. So both these issues have to be taken care of while framing the regulations. And in treading this path, regulators are often confronted with several challenges. The first being balancing innovation and stability. Innovation in the financial sector, especially in the last 6 to 7 years, the digital financial services expansion of the digital products has brought about transformative changes. However, the rapid pace of innovation also leads to regulatory gaps and gray areas. Innovations in the form of new business models or partnerships with third parties are actually often lying in the outside the regulatory ambit of the financial sector regulators. So we feel it is our job to plug these loopholes by framing rules in such a manner, but the intention should be to ensure that the gaps are plugged, the arbitrage is minimized, the conduct issues are addressed, but ensure that innovation is not stifled. So this is a delicate balancing act which the regulators have to strive in the times to come. We are adopting more agile approaches in such areas like looking at regulatory sandboxes and also enhancing dialogue with the stakeholders for integrating the new players into the regulatory framework while addressing the concerns, because ultimately if there is increase of risks in the financial system, there is a threat to financial stability, and I think that is an overriding or an overarching concern for the regulators. Second, of course, the regulators have to keep pace with the emerging risks and technologies. The regulators should be able to identify the emerging risks proactively and keep taking steps to address it. You look at in the last 6 to 7 years, the narrative has changed in the sense from earlier the traditional credit market risks. Today, if you look at it, I think the operational technology and cyber risks are that much more important. Perhaps in the times to come, those are going to be a bigger challenge. Climate finance is another area which is going to be very, very risky for the financial entities, insurance, or the banks. So I think we need to have a good mechanism to help us to identify the emerging risks and address this while fostering or providing space for innovation. When we look at this technology risks, if you look at the recent developments, one is the growth of emerging technologies, issues around data privacy, security, ownership and control of data, and also the artificial intelligence conundrum. Newer business models like the banking as a service model, which actually slices and dices the various activities which used to be integrated within a bank across various specialist agencies. The same agency can do it for multiple banks. So this is new, and with technology, they are able to do it quite in a cost-effective manner and scale it up to the requirements of the individual entities. So when we look at these issues, we face a dilemma. Do we develop a framework beforehand? We see the trends. Do we regulate beforehand? It can actually put a stop to the innovations. Or do we look at allowing some developments to happen and then intervene? In which case, there could be several cases where there will be customer complaints or issues around customer protection, somebody makes a loss. So these are some of the issues which we do face. So many of the times we do encourage new developments, new technologies, but at the same time, we tend to be very cautious in expanding the remit of these technologies. One example is the introduction of the video-based customer identification process. This was an innovation allowed in 2021 or so. But at the same time, there has been demand that this video KYC should be extended to non-residents outside the country. But there are, unless we are sure of the technology expanding it, we do not know whether the person who's being identified is not a fake generated through artificial intelligence. We have to be sure about that. So we have to ensure that while we can expand the remit of this innovation to other states or other players, there should be enough safeguards so that we are protected against spoofing or fraudulent activities from such entities. So I think that is a challenge which we face when we are looking at issues of regulating innovations in the financial services arising from new technologies coming in. Another dilemma for the regulator, of course, is reducing the regulatory burden and while ensuring compliance. See, India has made good progress in improving its business environment over the years, but there is still a lot of scope for improvement. And regulatory burden and compliance is a cost and a burden for the regulated entities, more so for the smaller entities who may not be able to afford or the cost of having a very strong compliance team. So we need to ensure a delicate balancing act between reducing the burden and compliance cost for the regulated entities, while it does not hinder the effective functioning of the markets. We have taken several initiatives in this area. Of course, we did internally set up the Regulation Review Authority twice in 1999 and again in 2021, which did look at some of the older instructions and obsolete instructions and took steps to withdraw these instructions, rationalize the reporting systems. A lot of work had been done in that. Then we also wanted a greater interaction with the people about the regulations which we make. So there has been a website called the Connect to Regulate, web link called the Connect to Regulate, which has been set up in RBI. So if we have areas where we want to install regulations, we want people to give their comments on regulation, the regulation or the draft paper is put out in the Connect to Regulate platform, and we can get comments from a wide set of activities, not necessarily only from the regulated entities, but from any interested stakeholder and any member of the public. This makes the process more consultative. We have worked on a platform for regulatory application, validation, and authorization, which is called the PRAVA, which is a secure and centralized web-based portal for individuals to seek authorization, license, or regulatory approvals. The second stage on that is work is going on. With that possibly the entire process of RBI regulatory approvals will be fully automated and that much more quicker for the regulated entities. We have reiterated our commitment to responsive and transparent regulation making through a comprehensive framework for formulation of regulations, which was issued a couple of months back in May 2025. It lays down the broad principles for drafting, amending, and reviewing regulations issued by the Reserve Bank. We are also looking at setting up a regulatory review cell which will look at reviewing all regulations every 5 to 7 years. I think this is something which has come as a recommendation from the Financial Stability and Development Council. So perhaps it gets extended to all the regulators over a period of time. So periodic renewal of the process by rationalizing the existing regulations in a more comprehensive and structured manner so that all the irrelevant instructions get wiped out. In fact, when we did this exercise of reviewing the regulations, we found we have been issuing regulations right from 1944. So 1944, it comes to more than 8,000 regulations. How many of 1,500 have been withdrawn through the RRA process? But there are still a huge plethora of instructions for the regulated entities, how to rationalize, consolidate, and simplify them for the regulated entities is engaging us, and hopefully we should have a solution on this area. And I think another big challenge in today's times is data capacity and resource constraints. If you look at it, when we want to make policies, you need data to get a sense of the underlying trend or make some intelligent inferences of the potential implications going forward. But having good data and having good analytical capacity to tackle this data is that much more challenging in the times to come. And the new financial technologies, of course, has led to an exponential increase in the volume of data which is being generated. So internally, we need to be equipped in terms of data analytics capabilities, maybe the engines like the artificial intelligence facilities, use them better so that we can make better sense of the data and the underlying trends so that that can then be used to make better quality of regulations in the times to come. Also, this will also necessarily require that we improve the capacity within the regulators to ability to analyze the data, ability to infer from the data, ability to make regulations, and also maybe better drafting of regulations. In fact, I think I have commented in an earlier occasion also that regulation making and maybe even rule making in the government are issues which actually is where I think we need to develop our skill sets because often we make an act gets challenged very often in the court. You make a rule gets contested in the courts. Regulation, people do not understand the regulations. So in all these three areas, I think better skill sets in terms of drafting is also a sequel which is required. So along with the ability, analytical ability to make or understand the issues and frame the regulations, but drafting the regulation so that it becomes effective and achieves the intended outcome is something which we will have to work going forward. But another key area in this entire edifice of regulation making is interregulatory coordination. Indian financial sector is more of a sectoral regulator oriented issue. We have multiple FSRs. I already talked about SEBI, IRDAI, PFRDA, IFSCA, RBI, you have Ministry of Corporate Affairs. So we need coordination between the regulations to ensure consistent policy making. You have financial conglomerates which straddle the spheres of influence or the spheres of respective regulators. So how do we regulate these conglomerates? What kind of principles should we adopt to that? Normally we say the lead regulator principle. The regulator for the principal activity of the entity is the lead regulator for that area. And having joint supervision and multilateral discussions or frequent discussions amongst the supervisors to address concerns around these financial conglomerates are some of the policy approaches, coordination approaches which we have in this regard. We also have the Financial Stability and Development Council headed by the Finance Minister and its subcommittees, which is headed by the Reserve Bank Governor, where all the heads of the financial sector regulators are represented. This provides kind of a combined platform for combined assessment of risk from financial stability, and plays a pivotal role for interregulatory coordination on matters where there is an overlap between the financial sector regulators. This forum actually helps in strengthening interregulatory coordination, and some of the recent issues like around the alternate investment funds, etc., have been addressed jointly by RBI and SEBI. Essentially, this reflects the coordination role played through the edges of the Financial Stability and Development Council. Now, of course, going forward, there could be challenges because there is going to be increasing partnership between technological firms and regulated entities. So the activities which are done by the technology firms will be outside the scope of the regulated entities. So how do we have oversight over the technological firms? Because the risks from these activities spill back onto the financial regulated entities. So coordination between these regulators is important. You look at areas like stable coins or crypto assets. These are mobile across geographies. It's very difficult to control unless there is very close coordination between the regulators in all the countries. So greater cooperation between international regulators would also be necessary in the times to come to address some of these emerging challenges. So given this entire plethora of issues, what could be the way forward? See, there is no perfect approach for making regulations, but principle and outcome-based regulations is more suitable for mature markets. But there are certain areas like conduct-related issues where a rule-based approach is quite useful. So when we look at regulation making, while a principle-based or an outcome-based approach is something which we would strive to achieve in the times to come, given the fact that Indian financial markets are becoming that much more mature. At the same time, rule-based approaches are very useful for areas like conduct, where customer protection is at the forefront or the top of our objectives. Regulations have to be forward-looking, and sometimes we have to be proactive or preemptive in addressing these issues. And so this necessitates a better understanding of the emerging risks, and also in developing strategies through a wide set of consultations to develop a regulatory framework which will be forward-looking and address the emerging risks. We should also be conscious of the fact that while addressing the risks, we should not stifle innovation. And so, we should be able to leverage data and technology. We need to be forward-looking, and we have to be mindful of the fact that over-regulation should not end up in stifling innovations. So these are some of the challenges which we need to confront in the days to come. I think one important focus in times to come is going to be the regulatory impact assessments. I think that has been mentioned under the aegis of the FSDC. This is being increasingly recognized as an essential tool for policymakers to enable development of policies that are grounded in evidence, clear in their purpose, proportionate in design, and responsive to the real-world conditions. There are two essential elements of the regulatory impact assessment. One is a cost-benefit analysis of the regulation, evaluated either through a qualitative or quantitative parameters or a mix of both, and greater consultation with the broad spectrum of stakeholders. The latter approach of consultation will lead to greater transparency, foster trust, and improve the quality and effectiveness of regulations. The cost-benefit analysis will help to determine optimal solution for addressing the problem while ensuring effective allocation of resources. Then another important area for regulators is timely review of regulatory prescriptions and reporting mechanisms so that we are streamlining and rationalizing them and making them more effective. This will not only reduce the compliance requirements, but also offer the regulators an opportunity to review the appropriateness of regulations in line with the evolving market practices. There could be some prescriptions maybe we have made in 1998, or maybe something which was made in 1967, which is still applicable. If we have a review, we will know that these regulations are no longer relevant and it's time to change or adapt or modify these regulations. So regulators should endeavor to adopt best practices in their regulatory approaches, both ex ante to assess potential impact and avoid unintended consequences, and ex post to assess the actual impact and support course correction while enhancing future rule design. So that together they ensure that the regulation is right the first time and kept right over time. The regulators should have a broader vision of enhancing tech compliance by the regulated entities to make it easier for them to comply with regulations. Supplement the better drafting of the regulations, I already referred to it, so that there is clarity in the regulation. Give examples like having fully answered questions, illustrations as part of the regulations to benefit the regulated entities. As we said that, I referred to the fact that we have more than 8,000 odd regulations which have been put in place over a period of time. We are now looking at trying to consolidate these regulations into about 30 or 35 master regulations so that the numbers come down. First stage would be consolidation, second would be rationalization, so that in the end, eventually, these regulations would be the ones only the entities will have to look at in the times to come. So that should hopefully make it that much easier for them to comply with the requirements in the times to come. Given the cross-sectoral operation, there is a need for moving away from a silo-based approach or a sector-specific approach towards cross-functional principle-based regulations. Better coordination among the financial sector regulators, both nationally and internationally, is necessary so that the risks which are emerging through the financial ultimate objective of all these regulations is strengthen the financial stability of the entities and also improve the conduct and ensure that customers get a fair deal. So better cooperation between the regulators, both either at a national level or at the cross-border level, will be required so that these objectives are achieved. Cooperation amongst regulators across jurisdictions is also essential for sharing insights, expertise, and resources to enable more efficient regulations without compromising on quality. To some extent, I think the Basel standards kind of reflect that because it is essentially distilling the experience of various jurisdictions on a particular area, analyzed with what do you call data, and then you come out with certain broad principles which are then commended to the various regulators for implementation. So that harnesses the benefit of international experience to ensure that the best practices being followed in our country is in alignment with the actual risks and what is being practiced across the globe. So there is some kind of harmony in the regulatory frameworks being adopted across the countries. But in all these processes, as I keep emphasizing, customer centricity is very, very important because ultimately all these regulations have an impact on the business of the entities, and the business of the entities are essentially arising from how they meet the needs of the customers. So regulators should remain conscious of the need to empower customers and safeguard their interest. They may have to think beyond the conventional approaches. Maybe behavioral economics here will offer a powerful tool, providing valuable insights into consumer behavior and decision-making process. And it can equip the regulators with advanced set of policy instruments like behavioral nudges, which can complement regulatory outcomes, uh, conventional regulatory outcomes, and at a far lower compliance cost. So to sum up broadly, I can say that regulatory policy in the financial sector must strike an optimal balance between the need for stability and objectives of fostering innovation, efficiency, and competition. While it is necessary to minimize systemic risks and protect consumers, it should not discourage creativity, innovation, or healthy market dynamics. An overemphasis on innovation and competition without adequate safeguards can lead to financial instability, resource misallocation, and loss of confidence in the system. Finding this right balance is particularly important for India, given the immense size and the heterogeneity of the economy, the growing aspirations, and the substantial investments needed to sustain high growth and development. Regulators must consistently strive to achieve this equilibrium. I'll end with a quote from Mahatma Gandhi: "You may never know what results come out from your actions, but if you do nothing, there will be no result." So I think we have a way forward in how to approach the regulations in the times to come. We are following that steps in RBI, and other regulators are also increasingly adopting it. So I think that is the way ahead as far as the regulation making is concerned. Financial markets is an important area. I think that will get covered in the next 2 to 3 days, and I hope you will have some fruitful discussions and interesting insights to imbibe in the times to come. Thank you very much.
So thank you, Deputy Governor, for a very, very perspective speech. And as you're finishing your speech, I've already got so many word messages from all over the markets, appreciating your perspective on financial regulation and sort of market regulation and all. And I think this speech will set a lot of thinking among financial market participants. And it's just the right backdrop to the program we are having for the following week. So this is something really a very, very useful perspective you have raised. A lot of questions, some answers, and there will be a lot of further questions debated about it. One thing which is straight away coming to my mind is, yes, we have been oscillating between single regulator, multiple regulators, now your twin peak model. So is there a case to relook? And if it is a case to relook, then what are we having in our mind? So one obvious thing is you have pointed out, and I'm not saying in the current context because system seems to be working pretty well. I mean, the inter-regulatory coordination I'm seeing is at its best for many, many years. And also the FSDC is handling things pretty fine. But there are cycles, and there are political cycles, there things change. And do we have to relook over the institutional framework in the sense that if there is a systemic financial crisis ever in the country, and certainly we cannot rule it out forever, I mean, these things do happen, then what is the legal framework we have? Who is responsible for the systemic stability in India? There is nothing in law to say the central bank is. There's nothing in law to say FSDC is. So then it's an issue that you might have very good coordination, but there's also a possibility that things may not really work seamlessly. And especially when we are seeing in the world cycles taking place over global financial crisis did occur, and a spate of global regulatory reforms occurred, and things were put on the par. But after that, when people tend to forget that regulation is important, then people start saying credit is important, growth is important, and that's where we have to move. And therefore, there is a pitch to dilute the regulations. So how do we blend these and have a right mix? So this is something which was, anyway, I'll leave it to you, but I'll open the floor for questions also, and later on you can touch upon these. Maybe from the floor, any questions? Yeah, please go ahead.
I have questions. One is a more philosophical one. So, sir, last year Ruchir Sharma's book came, Why Capitalism Failed. So essentially, he talks about that regulators essentially need to function as a safety net, but over the time they have become more of a trampoline, safety trampoline. Okay, so from that perspective, to what extent, as you also alluded, that we want regulation but not at the expense of innovation. So how to balance that particular aspect? Because if something is failing systemically, must be allowed to fail. But what we are seeing is that banks constantly being bailed out or being merged or some, but essentially they're not being allowed to fail. This has been the trend for quite some time now. So what are your comments on that?
No, I think I would say that regulators function as kind of a speed breaker on a highway around at a curve. It protects the car, it protects the pedestrians who are around that area. So while it does function as a speed breaker, it should not end up as a trampoline. I mean, it should not be a vehicle breaker, so to say. Striking the right balance is perhaps something function of your expertise and experience over a period of time. That's what I think that is the first issue. Second issue is as far as the banking system is concerned, let us be, what do you call it? If you look at it, India, when it started off in 1934, maybe 200, we had a huge number of banks, maybe more than 500, 600. After the BR Act came, a large number of banks were merged and closed down and then I think maybe we have come down from 250 odd commercial banks in early 60s down to a much more reasonable number at this point. I think 99 scheduled commercial banks or something is the I think rough number, including the RRBs. I'm not including the urban cooperative banks or the NBFCs, which is another big number. But I think if you allow the banks to fail, it tends to undermine the confidence of the public in the finance. India is a society which is still being financially included. Your credit to financial sector to GDP, bank credit to GDP is in the range of close to 60% at least. So if you want greater and greater inclusion, you have to ensure or reinforce the confidence in the banking system. So at this point, if you allow a bank to fail, that can create that much more of a negative impact on the financial stability. So we need to be cautious when we have approach this issue at this juncture. Maybe in the times to come, as the Indian market, financial market becomes that much more mature, that much more bigger.
Right.
Perhaps the tolerance for a failure could come at that point in time. But this is not an opportune moment to look at. I think we have to ensure that the financial stability is maintained at all costs.
So second is a specific question related to PSLCs. So essentially, since its introduction, so there is a general level of debate around it so the idea was that the RRBs need to be profitable as well as the credit expansion should go up. So what our observation at least is that credit expansion has certainly gone up, profitability not so much. And also there is some issue as to have they actually increased because credit dispersal rate has gone up, but outstanding not so much. Now there are 2-3 views around it that maybe greening is happening, or simply they are securitizing it and selling it off. From a credit risk point of view, what is your opinion around it? Is it a good policy to be in place or not so much?
No, it has been PSLC has been an innovation which has been there for a fairly long period of time. There is a school of thought which says that PSLC essentially enables the banks to, cheat. They can get a higher priority sector target without actually doing the lending. They can buy it off. But on the flip side, there is a good business model for some of the RRBs or the small finance banks who have a huge chunk of portfolio in the priority sector, which they can offload at a reasonably good profit and earn some income. Right. So both are there, but see, at least if the reach is ensured either through the endpoint agency and they get some benefit out of it, I don't see any harm at this. But I think the jury is still out on whether the PSLCs should be banned or not, but it continues at this point in time. And we will take a view.
So your opinion is that 7-8 years is a relatively short period of time to evaluate it as a policy tool?
I think it's been there for much longer.
In 2016 it came.
PSLC?
Effectively, they started doing it in 2018.
It has been there for longer. Maybe corrected, but.
Thanks, Arjun. He's a PhD student. So
Yeah.
Go ahead, Professor Deva. He's legal expert.
Okay.
So just would like to take forward what Professor Mridul was mentioning regarding the institutional reform. Is it an opportune time to relook at the financial sector a legislative reform report, which we had around as in 2011 sometime. I think we had the report. So is it an opportune time? That's one question. Second is that can you please throw some light on the use of regulatory sandbox? How RBI is looking at regulatory sandbox in the context of the innovative um, fintech and other sectors coming up. And third, if possible, what is the regulatory approach towards crypto or digital assets, which
See,
RBI is looking?
okay, on the crypto assets, of course, I'm not really authorized to say on much on that. But the official stance of RBI has been crypto doesn't give any value addition, so it's not an asset which should be allowed in the first place. There are risks to the consumers and to the system as a whole from that. But going forward, maybe I don't know how the stable coins will evolve, because maybe there was a stronger point of view that stable coins are also risky at a particular point in time. But now US has legalized stable coins. Maybe some of the other countries are also looking at stable coins. So this may be an innovation which would come in time, but we'll have to look at how it can be regulated. There's a government committee which is looking at the issue of crypto assets and stable coins. When they come out with their report, I think we will have to take a call at that particular point. On the first question of regulations, one point which strikes me is that famous saying, no, why fix something which ain't broke? So I think the system has evolved over a period of time. There has been a better improvement in the coordination. Each entity or the sectoral regulator is discharging its functions. And with RBI as a lead regulator and also as the lender of last resort, wherever there has been a potential crisis, that has been headed off. I think Mridul will also bear me out when we looked at the Franklin Templeton issue in 2020.
Yeah.
I think it was a very quick decision taken on the spur of the moment. I mean,
So
when
just
they
for
came.
the participants' benefit, this thing happened on Friday, and Saturday and Sunday we worked those solutions and opened the lines even before the market was open. It was a tough call. It was tough call because um, it was not clear whether it is a Lehman moment for India or not, because amount of redemptions which were sort of flowing in at that point of time. What I gathered from the CIOs of the mutual fund was it was just tending to explode. And in a sense, the regulation part of it was not really sort of feeling that the sort of thing one needs to act in a haste. But the point is, with these multiple equilibria that exist in the market, if you don't act in time, it is too late. And that's why it's always good sometimes to avoid those Lehman moments. And that's what we did.
No, even like
by-
when ILFS came, I think
Mm.
immediately, I think there was a joint statement issued by RBI and SEBI that we stand ready to support. And
Yeah,
there
but
is,
this
so
leads
these kind
me
of
to a question, sir.
coordination exists, and coordination is addressed at a particular point in time. Even during 2008 crisis, couple of statements were made. So there has been measures taken. So I think the regulatory coordination where required is immediately implemented. So institutional structure actually, I mean, by if the existing system is working well, or if it has broken down, then there is a case for a reform or rejuvenation. But if it has not broken down, it has delivered and the stability has been ensured, I don't see any reason why it should be disrupted at this point in time.
So
I think the third question I missed out, sir.
The regulatory sandbox. How?
No, regulatory sandbox, we do look at several issues now, like some innovations which are taking place in video KYC, let us say, how to bring it about. So that is tested in the sandbox. And once that solution come, maybe then we can think of extending it for the non-residents as I.
So my question was coming in my mind that is RBI going to relook at the time-tested principle that liquidity support to mutual funds has to be provided through banks, not directly. And I saw some statement to that effect coming in the thing. And there's also this FSAP issue regarding this.
I don't think I can comment on
Oh,
that.
that's fine. That's okay. So that's okay. Yeah, please go ahead, Professor Rudra.
Yes.
Yeah, sir, thank you for the very insightful talk. You mentioned cyber security and cyber fraud, and later you also talked about consumer protection. So, I see a growing risk because of the cyber frauds that we read about in the newspapers and issues of, cyber arrests. And I think even RBI employees, Cooperative Bank had suffered losses, and we have news of even, former RBI employees falling prey. So, where does the common man stand a chance? So my question is that, I know, there are processes in place. There is an RBI ombudsman. Banks have to take responsibility. But what is the RBI thinking about empowering the common ordinary depositor who may not know what are her rights? And when such cases happen, there's also a financial stability risk of, let's say a massive, round of such frauds happening, and people pull out their money from banks and hold cash or go into risky assets. So what steps is RBI taking to
I think,
empower the customer?
No, one is the grievance redressal mechanisms have been strengthened through the ombudsman process. We have an internal ombudsman scheme. We have a RBI ombudsman scheme which looks at this issue, supplemented with a what do you call center where the complaints can be registered, easing the process of registering complaints, improving the compensations given for the deficiencies in service which an ombudsman can award to the customers. So those are some of the steps in the grievance redressal space. As far as the frauds are concerned, see, one thing is perhaps it's a fallout of the digital innovation, because the innovations have expanded so dramatically in the last 6 to 10 years. It becomes, people's ability to keep change with the technology is bit limited, and you are having a dilemma that you have maybe a large chunk of elderly citizens who may be technologically challenged. You also have newcomers into the financial system who may not be that tech savvy. So how do we address that? Maybe awareness is something which is actually a very effective way in my view, because awareness, and if you look at it, the various RBI Kehta Hai campaigns and other campaigns run by NPCL, run by SBI, run by the other public sector banks, those have actually tried to caution the customers about the downsides of falling prey to these kind of scams. Now, if you look at this digital arrest, I think it was very prominent in a recent period when you had a huge number of headlines. Now the number of headlines has dropped off, so I presume the effect of our measures are taking place. But having said that, I think we should also internally, we will look at whether there could be some measures which can help to empower the technologically challenged customer, whether it's a senior citizen or a newbie to the financial system, so that they do not fall prey to such kind of vulnerable active phishing activities from the various. But having said that, it's always a race, cops and robbers kind of thing, Somebody is always 2 steps ahead. They may think of something more innovative. We'll have to ensure that we go ahead and plug those gaps. So how quickly we respond to that is going to be the challenge for us in the times.
Thank you so much, sir, for enlightening us about the regulation and innovation importance. So my question is kind of a follow-up. So we have seen how the RBI and the government of India have placed emphasis on the financial inclusion through the digital products, and many new financial products are coming up. But yet many Indians, they still hesitate to engage because of the lack of complexity, also about the cyber security frauds and the lack of trust as well. So how does the RBI plan to strike a balance between regulation and innovation that makes it not only easy to purchase for the coming generations, but also it ensures a user-friendly and transparency for them?
No, I think the entire framework of regulation making, as I said, we are revisiting the way we look at the regulations, in the sense that more consultative approach, more data intensive analysis of the regulations and its inference about its likely impact, paper for public consultation based on the feedback, a framework for framing the regulations, And while doing so, we are also, as I said, trying to consciously look at that we do not stifle innovations. When we looked at the digital lending apps in 2020, especially during the COVID time, there were a spate of issues where people were harassed and a lot of people committed suicide, etc. We did study the issue. We came out, had a detailed document. The Jain Das report was there on digital lending issues. Based on the recommendations of that committee, we did frame the digital lending guidelines, where to a great extent, and that too with a lot of engagement and consultation with the fintech players. So as a result, what happened is the final guidelines which came was did not, I mean, undermine their business, but at the same time, it tried to safeguard the interests of the customers to a great extent. So I think that was the kind of striking the balance. But the challenges will remain because, as I said, you come newer players, they think they have a good business model which is attractive, but it could be detrimental to the customer. Maybe once we come to know, we have to see whether it fits into the existing guidelines or is it a new technology, new issue. Is the technology good or bad? And based on that, you think of what kind of regulatory framework we should have for that. So I think it's a constant evolution as far as the regulation making is concerned.
Yeah, so really, I think the digital issues are coming in the fore in a big way. And that also would fit into your major theme about how like various regulators can deal with it. So is it that the subcommittee of the FSDC, a lot of such issues have to be grappled with? I mean, who will be controlling the platforms? There are angles from the securities market side, there are angles from the banking side. So do you need to keep platforms separate?
No, in fact, actually, electronic trading platforms are governed under the RBI, ETP guidelines broadly. Exchanges is another, it's a platform, but it's in a different sphere altogether. It's regulated under the SERA. So, because electronic trading platforms
is aggregating securities.
No, it essentially is a mechanism which facilitates kind of a bilateral trade through a platform with greater transparency.
Okay. Yeah, please. I think the civil servants also need to.
Thanks, sir, for your.
This is learning class, so that you can be free. I mean, this is.
Thanks, sir, for your wonderful insight. My question is regarding one very apt point which you have pointed out. Now the services are sliced and diced into various small parts, and various fintech companies are coming which are doing work in niche areas. So how a regulator should frame the policies to for these types of services which are going into the niche areas? Further, there are various vendors which are behind various layers, third layer, four layers. So how a regulator should work on their policy while framing policy for these?
No, in fact, that, as I said, is some kind of a emerging challenge as far as we are concerned, because you have regulated entities, you have the non-regulated entities offering the services or outsourcing, to whom some of these services are being outsourced. So how do we regulate? We try to regulate through the regulated entities by framing outsourcing guidelines with the do's and don'ts and the governance oversights, and maybe ability of the regulator to come into and verify these documents. That is one way of addressing the issues. So, but I think the non-regulated entities also create their own set of risks. As I said, rather operational risk, now it's actually transforming into kind of a technology risk, because let us say, it's not just risk of loss in the financial entity, it is a risk of vulnerabilities in the outsourced entities, in the other channels which are used. Let us say a fraud happens or a virus comes on a payment channel. Payment channel may be offered through a broadband which is run by Airtel or Jio or some other telecom operator. That also can actually become a spillback risk on the regulated entity, even though their mechanisms deflect or address some of the potential threats to their system. But this channel could be a vulnerability factor for them. So the whole of technology is something which we will have to look at risks and how to address these risks through regulatory intervention. So some of these are, I think, evolving challenges. I don't really have a very ready answer to it. One way is addressing it through the outsourcing guidelines, but newer challenges are emerging. We will have to see how it can be addressed.
So second question mine related to the compliance burdens on small players. So right now what we are seeing, technology is growing at a very fast pace, and there are various cyber related policies and technological related policy which we regulators keep on prescribing for these market intermediaries. So means could we create a regulatory environment like a light regulatory environment for small players and more major policies or more major regulatory compliances for the players who are having a bigger say in the
Yeah,
market?
that's exactly what we have tried to do when we looked at non-banking financial companies, because our scale-based regulation is light touch for the smaller entities, more prescriptive and more intrusive on the larger entities. And especially if you are in the upper layer, that is entities with the prescriptions are almost like banks. So I think that scaling of the approach or commensurate with the risks or the size of the entity is something which we are cognizant of, and we are trying to do that.
Yeah, we try covering that in the course. So like scale-based is very important, and he rightly pointed out that it's also risk-based. The prompt corrective action is inbuilt into the scale-based regulation. So I think that's one way to go about things. So any more questions? Sophia is PhD student who works on relationship banking. So let her. So, okay.
Good morning, sir. Sir, is there any regulatory mechanism for the banks who are actually adopting the extrajudicial tactics to garner money from the loan defaulters? They are small loan defaulters. We see in papers that there are big fishes are roaming around, but the small loan defaulters are being harassed like anything, and the banks are being allowed to do that. So, is there any regulatory mechanism which can control such tactics?
No, in fact, actually the bankers are subscribing to the fair practices code for what do you call lending and recovery of monies from that. There is a very detailed guideline which the banks are supposed to follow when employing the outsourced agencies or the recovery agencies, the timing when which they have to go to the borrower, what kind of approach they have to do. All those are very detailed guidelines. So if the guideline is in place, if the banks violate the guideline, in effect they are violating the RBI norms, and we have come to the issues has come to our notice, or where we have observed some practices, we have taken very heavy action also. You may recall there have been a couple of NBFCs where the fines were imposed in the region of 4.5 to 5 crores, and business restrictions were also imposed on the agencies because they were not following the norms. The restrictions were withdrawn only after they confirmed that the guidelines are being followed meticulously. So these steps are being taken by the Reserve Bank when it comes to the entity. There is a guideline in place, and the banks are expected to follow the guidelines, and enforcement action is taken where they are found to be violating the guidelines.
Sophia?
Thank you, sir, for such a wonderful talk. So my question is about the RBI itself. Now, technology has become such a buzzword. So now we need regulators who understand the regulatory landscape and maybe have a broad understanding of technological innovations as well. So I'm trying to understand, what kind of workforce are you trying to build at the RBI, and what kind of skills will the RBI of the future need in terms of, I mean, what kind of people are you looking to attract, and how are you planning to skill your existing workplace to keep pace with the kind of technological change that is?
Difficult, interesting, and a difficult question. It looks at manpower in the future. You're exactly right. I think this is a challenge which we are facing, because as I said, regulation making is becoming that much more analytical, inferential and maybe evidence based. So that is something. So more people with the skill set to analyze data is something which we are looking at. Internally, we have several mechanisms for people to upgrade their skills at all points in time. We do find that there is a greater number of engineers who do come into RBI. So technologically, they tend to have quantitative aptitude. So picking up skills like risk management and other areas, many of them are very good analysts. In our Department of Regulation also, we have some very bright youngsters who can understand, analyze and infer and make the policy diagnostics or the recommendations. So we are having the skill set, but going forward, I think that skill set needs to be upgraded constantly. So constant upgrading of skills within the staff, identifying the skill gaps which we do not have. We think of either taking them as a direct recruit if they do come, or maybe laterally if required. So this is part of the entire manpower planning process which we do follow, and we try to ensure that the skill sets required within the RBI are aligned with our regulatory and other technological requirements. That is something which is an ongoing process.
Thank you, sir.
So thank you. I think we'll bring close to this proceedings here for some very wonderful sweep of issues we now have got on the how the regulation should be structured, entity regulation, market regulation. We'll have more of this discussion in the coming period. We'll have a lot more of discussions as we go around on market and entity the issues. So there is a small memento for you from Brian Desai. Thank you, everybody.